My slippers, so comfortable, and they're designed to be worn indoors and outdoors. They're made from quality leather suede with the My Pillow patented foam and impact gel to help prevent fatigue. Go to mypillow.com today. Click the radio listener special. Get $90 off every pair. Just use the promo code YES. And this is only while they're in stock for a limited time. Go to mypillow.com. You get the 60-day money-back guarantee. They'll be the best slippers you ever owned. Do it right now. mypillow.com. And to get $90 off, use the promo code YES.
Now, your host, Ken Brew, on News Radio 700 WLW.
206, and welcome back. It's the Craftsman Electric Saturday afternoon extravaganza. Craftsman Electric, quality craftsmanship. It is in their name. He who hesitates is not lost. He who hesitates in the real estate game probably lose the property that he or she wants. Listen to this. Real estate investors are rushing in. And apparently these investors are cashing in. There is a curator of land and property data, a group by the name of Atom, estimated that in the first quarter of this year, that the typical return on an investment property, 47.2% higher than the 37.5% return in the first quarter of 2021. Of the 25 metropolitan areas, Atlanta ranks number one. Nearly 33% of home buyers were investors, and another 40% were made in all cash deals. There are 25 metro areas that are ranked. Guess who's number 20? Right, us. Cincinnati. Somebody that knows all about this is a real estate expert, an elite coach of some of the top agents and teams across North America. He is Cliff Freeman. Cliff, welcome to the show, and how are you on this glorious Saturday?
Ken, I am just close to perfect this morning. How about yourself?
I'm somewhat south of that, but, I got like 10 hours until I hit midnight, so I got time to work on getting perfect. I think I'll work on that. Thanks for setting the bar that high. Listen, the real estate industry is, I don't know where it is right now in the wake of what the Fed did this past week. Can you just give us a thumbnail look of what the Fed raising rates 3/4 of a point, with probably another 3/4 of a point coming the end of July, but just right now, where is the real estate game, and how did that affect it, that Fed hike?
Right. Great question. As you know, affordability, home affordability really comes in two parts. One is with respect to home prices. And I just did some research in Cincinnati. In the last 12 months, home prices overall are up about 12%. If we go back 24 months, that's 25%. So if you're out looking for a house, and as you said on the intro here, if you're waiting, my dad used to tell me when you go to somewhere to like a dinner party, you better eat when they pass out the appetizers because they may not have enough of the main course to go around.
Yeah.
And, that's essentially the run-up has just been extraordinary since COVID, and it's really been a supply and demand issue. But that's only one part of it. The other part, and the most significant really part that we pay every month, the rent on the money, or in other words, the interest on the mortgage, has gone up substantially. And just to put it in perspective, Ken, every time at this level that, say, the 30-year fixed-rate mortgage goes up 1%, that effectively represents a 10% reduction in a purchaser's buying power. Let's just say they're putting, a fairly minimal amount down. But that's the impact that it's had. So the cost of money right now has gotten much, much higher. In real terms, over the long term, a 6% rate's not horrible. Back in the 80s, we were looking at, 12, 14%. But for most people, this is the first time they've seen rates over 4%. And, that is going to be problematic. That's where the brakes, the Fed is pumping the brakes here on the real estate market, and they're trying to tame this runaway inflation that we have. And unfortunately, that could be pointing to the perfect storm if they're not careful, and they could push us into a recession. And that's a whole nother conversation.
Yeah, no, I know. I mean, I lived through the late 70s and early 80s. I bought my first house in Tulsa, by God, Oklahoma, and I think I paid I think my interest rate for that was 13 and a half. Might have been higher than that, 13 and 3/4. So I know what it is, what it's like to have to go that. I don't sense it's getting anywhere near that now. But I was just wondering, and I've had financial people on the show and whatnot. It seems like the Fed is starting to bleed this rather than just trying to, and excuse the expression, puke it out of the economy. It would have been, I think, much more beneficial just to get that rate up high. Everybody staggers for about 6 months, but then we're over it. I just sense this is going to come incrementally now, and it's never really going to fix the problem. It's just going to put a Band-Aid on it. How do you feel about that?
Well, there is a correlation somewhat between what the Fed does and what happens to the 10-year. But here's what the Fed is. They're on a balancing act right now. And if they kill it too fast, if they raise too fast, then we really need to watch the yield curve. And historically, the shape of the yield curve has been a pretty good predictor. Once it's inverted, and what I mean by inverted is that short terms are higher than the long-term rates. In other words, the Fed rate is the shortest, and then 30-year fixed-rate mortgages are priced off of the 10-year Treasury. So if investors are dealing with a high cost of borrowing in the short end, yet the market is telling us that in the long term, things are going to come down because the 10-year Treasury is trading below or well below the 2-year, then that's a recipe for a recession. Yeah. And so the Fed is trying to really just kind of pump the brakes on the housing market and at the same time not push us into a recession, because in that case, we could be looking at what happened in the 70s with stagflation, where we had inflation and a stagnant economy. And that would be a really tough thing for us to deal with, and it would be a long-term problem.
Yeah. Well, I mean, I don't have to tell you the housing industry has been on fire for the last couple of years, and people paying well over appraised value, and all cash is king. People that make cash buys, they're going to trump everything. But what's going on here with investors that are coming in? I mean, Cincinnati is 20th out of the 25 metropolitan areas on this survey. Atlanta's number 1. Atlanta, with 33% of home purchases, were by investors. Who are the investors? Are they people that are just trying to buy and flip? Is this money from overseas? Who's buying all this stuff?
Yeah, that's a great question. And, the National Association of Realtors recently put out a study called The Impact of Institutional Buyers on Home Sales and Single-Family Rentals. And what we learn in that research is that there's a mix. These, when we say institutional, we're just talking about entities that are not individual buyers. So they could be mom and pop LLCs, they could be hedge funds. But the reality is that we know that Wall Street has taken a keen interest in the excessive returns that real estate has generated since the beginning of the pandemic. And they're always chasing yield, especially when rates are down. They're looking for the next, mousetrap that'll earn them 200 or 300 basis points more, and then on a risk-adjusted basis and so forth. But what that created, Ken, was an imbalance in our supply and demand. And when you've got the percentage of buyers in Texas, it's particularly bad. I think statewide it was about 28%, but just in Tarrant County and Fort Worth, about almost 44% of all the buyers were what they call institutional. And so that really, they're chasing these deals with cash. And for the first-time home buyer, these millennials that are coming into the market, I mean, they've just been caught in a tidal wave here of inflated house prices. And now the double whammy is the fact that rates are up almost 300 basis points from just the first of the year. So it's been quite a shift in the market.
Yeah, I mean, that's such a great point. I mean, if you're a millennial, if you're a first-time house buyer, like let's say you're married, maybe junior's on the way, you're in your mid-20s, you want to buy a house, you want to get out of the apartment, you want to get out of mom and dad's basement, wherever you are. If you're going out looking for a house right now and you're trying to do the old conventional, I'll put 20% down and we'll finance the rest over 30 years, you may not get out of the starting gate. I think that's what you're saying, right?
Well, if you're in the housing market right now without professional help, I really think you're putting yourself at risk. You need to find somebody that you can have as a trusted advisor to help you through these times. People's motivation for buying they're all different. Some people have a much stronger motivation to buy than others. Speculating right now in this market, I think, could be very risky. I think if you have to own a house, then you know what? The great thing about real estate is it never goes to zero. So if you stay in a house long enough over time, even if the value drops, you're still going to make up. And, you know, it's kind of like walking upstairs with a yo-yo. Eventually you're going to get to the top, but it may be an up and down, you know, trip between the beginning and the end. So, you know, real estate, it's been proven that real estate is where most wealthy people create a lot of their wealth. They all own real estate. You know, renting is just paying somebody else's mortgage. You don't have the tax advantages, and, you know, you just have to think about it. It's, you know, Robert Kiyosaki really explained it well in some of his writings, but, you know, you have to do what's right for you in your situation. And I think that getting the best advice from a real professional is the only way to go at this time. It's just too much going on to do yourself.
I wholeheartedly agree. You need somebody that has got their eye on the ball for you. And just because, you know, you think you can figure rates and shop and all that, you're also trying to work, raise kids, do whatever you're doing. Your eye isn't on the ball 24/7. Cliff Freeman is our guest, real estate expert. We're talking about how Cincinnati and 24 other metropolitan areas are now seeing a large number of investors coming in and buying property here. But what I wonder about all of this is if the brakes are being applied a little bit here, it's not just the housing industry, it's all the things that go along with it, like the people that put the frame up and do the punch out work and all of that. Where do you see that going here as they try to corral inflation? What happens to all of these ancillary businesses?
Yeah, that's a great question, Ken. And I think a lot of people may not realize how many jobs are created every time a house is built. I mean, you have all of those, you know, different components, the different people that do the work, all of the supplies and materials that go into house building. You know, we would, and again, this is kind of unfortunately, it's one of those things where if the Fed is not careful, it's kind of a self-fulfilling prophecy. And, you know, the fear, and again, I'm not a fear monger. I sleep with sunglasses on at night because I still believe the sun might come up in the middle of the night. But what I will say is that, you know, if there are weeds in the yard, you have to acknowledge that there are weeds in the yard. And there is a potential here, you know, that the Fed could, you know, again, through monetary policy, go ahead and put the economy in a place where it's not good. And you know, we need houses here. In Dallas alone, we were 176,000 homes short of a balanced supply at the beginning of 2021. So it's a nationwide problem. It's been compounded by the fact that supply chains have been disrupted. People are just not working. I mean, I'm in Orlando right now, and I was at a great restaurant last night listening to how people, you know, they just can't find people to work. I mean, it's just a weird place that we're in right now. And, you know, I think that overall I'm very optimistic, but, you know, these things take time to play out. And if you recall, Ken, back in 2008, that's when the wheels started to come off, but it really wasn't until 2010 when we hit the bottom of the market. So this potentially could be a prolonged period of just sort of, you know, prices not moving, rates being higher, and just a more challenging. And the thing is that these institutions eventually, if they're not seeing the yields that they came in here for, they're not living in these houses. And that is another conversation as well about what happens when Wall Street, these hedge funds and so forth decide that they're done with this investment. I mean, they're short-term players typically, and, you know, they decide to exit. I mean, there's just a whole lot of dynamics that make this market very interesting and just a little bit tricky.
Yeah, very tricky. And interesting is really a mild term. I think it's going to be fascinating here as to where this goes, because obviously, as you well know, the housing market is a great indicator of other things besides that, not the least of which is the job market. Cliff, thanks so much for your time. This is interesting stuff. We appreciate it. And, hey, we're number 20 in Cincinnati. We'll take what we can get up here. Thank you.
Let's get the Bengals to the Super Bowl. Thanks, Ken. Enjoy being on your show.
There you go. I like that, too. Thank you, Cliff.
Thank you, sir.
Homes bought by investors, fourth quarter 2021, here in Cincinnati, in the greater Cincinnati area. 16.2% of all sales were bought by investors. Homes bought with cash in quarter one of 2021. Homes bought with cash, no financing, cash is king. Quarter one, 2021. January, February, March. Over 34%, 34.4%. The median sale price of a house in April of this year, which is the latest data available, median price $239,950, $239,950. Median time on the market. Now, again, everything is location, 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 and then what the price is, what the size of the house is, the shape of the house, all that stuff. But anyway, the median time on the market in Cincinnati in April of 2022, 38 days. And, you know, I mean, there's a guy that knows his business inside out, and he's still, nobody knows what happens to the housing market in light of what the Fed did the other day. Now, again, there are other factors that you look at financially besides what Jerome Powell did with the prime lending rate and jacking it up 0.75 of a point. You look at T-bills, treasuries, things like that. But the point being is it is so volatile right now that if you're trying to do something like this yourself, you're asking for trouble. You just really are. But I think that's fascinating. Homes bought with cash, quarter one, 2021 in Cincinnati. More than a third of the sales. Cash is king. People are sitting on a lot of cash. Not me, unfortunately. I'm sitting actually in a very nice chair. 222 News Radio 700 WLW.
For the banks of the mighty Ohio River.
Oh, my!
It's exciting NL Central action. Our Redlegs playing host to Milwaukee.